Hi guys, and welcome to yet another edition of the UTI Swatantra Facebook Live. I'm Nikhil Ananda, standing in for Govindraj Etiraj, who's traveling today. Well, the economy is in a bit of a crisis. The stock markets are gyrating rather with a great amount of volatility, and so all of you out there must be wondering, what's happening with your investments, what you should be doing with some of the money that you have there lying idle. And to answer some of those questions, the theme of this special show today is don't let the fear of losing keep you from running the race. And joining us are two very special guests. We have Salil Kothari, who is the founder and CEO of Cyclo Investments, joining us in the studio, and Mr. Paresh R. Suktankar, founder partner at Reliable Investments, and hopefully they're going to be helping us with the queries that you send in. So please log in there and send in as many questions as you'd like answered. And gentlemen, before we actually begin with the questions, I want to ask you to briefly introduce yourselves and tell our viewers about the nature of the work that you do. So Paresh, if I can begin with you.
I'm Paresh. I am a chartered accountant and a certified financial planner, and I am running this firm for last 32 years, and we are dealing with people's financial planning and wealth management, and we cover all the products which are suitable to our customers' goals and needs.
Right.
Yeah,
Salil?
just to give you a perspective, myself Salil Kothari, running a firm in the name of Cyclo Investments. Personally, I am a certified financial planner and a chartered wealth management. I've been running this organization since last 12 years. We are specialized into wealth management space.
Okay, so Paresh, I want to begin by really drawing a simple analogy between investing or financial planning and running a marathon, because many, particularly in this market, I believe, would think it's simply impossible for them to run a marathon or actually go out there, take a risk and invest their money. So how do you look at this, and what are perhaps the benefits of running a marathon or long-term investing that you would want people to understand?
Yeah, so basically in marathon, what you have to do is you have to last longer, right? It is all about stamina and resilience, and whatever obstacles come in between, you just cross them with no fear. Same applies to investing. If you invest for long term, there is hardly any instance where people have lost money if they have invested for 10 years or 15 years. Normally people, when they invest, they ask us what is long term. So there is no definition of long term as such.
Right.
Some people will make money in first 2 years, some people will take 6 years to make money.
Right.
It depends on when they are entering.
Right.
And what are the market conditions when they are entering.
Right.
Same way with marathon. Marathon is like you start with some 2 miles to start with, and then you go to 21 in 2-3 years.
Correct.
So as any business is also a marathon, right? You start a business, it takes at least 3 years to come on its feet, and then it goes ahead.
Right.
So that is the analogy I want to draw.
So you're saying, so when you say you start with 2 years, you're saying start small.
Yeah.
Get the flavor of things, and then
Yeah.
you can actually do the whole race.
Yeah. And when you start practicing for marathon also, it is your duty first to go to a doctor and find out whether you are fit to do it.
Yeah. And in this
And
case,
slowly scale up.
Absolutely.
Similarly, you can test these waters with 1 foot to start with before entering the pool.
Correct. So, Salil, just the same question to you. How are the two similar, investing and a marathon, in terms of, preparation, benefits, strategy, and what, you should really be sort of looking out for when it comes to the outcome?
Right. So in a marathon, as you said, day one, no one starts with running a 42-kilometer race. Slowly, gradually, you build up your number of kilometers. So there is a strategy behind doing it. There is a methodology behind building up your strengths. You need to practice it over a period of time. That is how you should do it.
Yeah.
So similarly, like in a financial planning or the investment world, what you need to do is first to identify your financial goals.
Correct.
What are your financial goals in the form of short-term goals or the long-term goals? Goals could be like your retirement goals,
Correct.
like your child's education or your dream vacation or a dream house of yours. Once you have identified all your goals, then you need to prioritize your goals. prioritizing which is your topmost priority, what amount of savings, what you need to do for that kind of priorities of goals. So once you have identified, prioritize your goal, then comes actually how much you need to save for that goal. So it's basically how much you need to invest, and then do your rest of the expenses what you can plan accordingly.
Right.
So doing a financial planning would help you to understand the various products which are available in the market, whether it's your equity, whether it's your debt, whether it's your gold or real estate, how this asset class performs over a period of time. So if you are able to understand all the asset classes while doing your financial planning, you would be able to stay course while the plan has been executed, and over a period of time you would be able to achieve your goals.
Right. Paresh, when you run a marathon, you need to have a long-term vision, because you're planning for it, and then you're seeing the benefits accrue over a long time in terms of what it does to your health and so on. But a lot of people who are possibly invested in mutual funds right now or want to invest, maybe forgetting the importance of taking a long view when it comes to investing as well, because they're seeing their stock market portfolios every day or their mutual fund portfolios every day, the volatility therein, some of their funds perhaps in the red, and then they're worried suddenly about whether they've made the right decision. So tell us a little bit about the importance of taking a long view of things when you're investing.
See, basically when you are doing marathon planning also, you know what are the risks involved. You should be able to judge what are the risks involved. Risks involved may be many, because it is going to be at least a 2.5 hour journey in a 42 kilometer marathon. Anything can happen.
Yeah.
It can start raining.
Yeah.
Your shoe may get torn. Your stamina may need some more water than what is normally required. So once you know the risk, and once you know your destination, and what are the hurdles which are going to come in between, you are mentally prepared. Same way in investing, you should know what are the risks involved. First of all, as a financial planner, I don't think there is any risk in investing. It is just volatility.
Yeah.
And volatility is not equal to risk.
Right.
Volatility is, it's not a smooth journey, it's a rough journey, but ultimately your goal will be achieved. If you plan well, what is the time horizon of your goal, what is the product which is suitable for that time horizon, then you can plan in such a way that you don't get scared.
Yeah. So
see, when you will get scared, when things are not going according to your plan.
Correct.
But if your plan and goal is far away, and if you revisit the goal every 1 year, let's say marathon, or somebody starts a marathon practice, within 2-3 years he is able to run 21 kilometers, within 5 years he is able to run 42 kilometers.
Right.
So similarly in this investing world also, if you know the risk, you know the preparation involved, you know what to expect. What is unexpected also can happen.
Correct.
If you are ready for that, you don't get scared at all. In fact, you will look at this volatility as an opportunity.
Correct. But so, when you say a long view of things or long-term sort of planning, typically how much should your horizon be? Like time horizon, 5, 7,
for
10
every
years?
goal it will be different.
Yeah.
For me it will be different, for him it will be different, for you it will be different. So unlike in a marathoner, what a doctor will normally check is whether he is BP, he has diabetes, whether his knees are strong or not, and then he will say, okay, you can go ahead for marathon. Similarly, a financial planner also will judge your requirements, your needs, your goals, your time horizons required to reach that goal, and then he will devise a plan.
Correct.
So
But
it will be a mixture of all products.
What I actually meant was, what's the minimum number of years that you need to be invested in the markets to see sizable returns?
See, there is no
mutual funds.
There is no thumb rule for that.
Yeah.
For example, now since last 2 years markets have come down. If somebody invests in equity now, he may get excellent returns in next 2 years.
Next 2 years, right.
For somebody who has invested 2 years back at the peak of the market, he may take 6 years to achieve that return.
Right. Fair enough. Elaborate a little bit, Salil, on the sort of practical benefits of long-term investing. For instance, on tax or capital gains.
Right.
What are some of those benefits that are not available to short-term investors?
Right. From a long-term perspective, government have come up with an incentive where if you invest above 1 year for an equity funds or the equity stocks, it is 10% long-term capital gain vis-a-vis the short-term, which is taxed at 15%, or a bank FD which is taxed at your nominal rate of interest, which could be 20, 30, 35 or 42, it may go extend to. So one is on the tax benefit aspect, where government is incentivizing you for doing a long-term investment. Although they have kept 1 year as a long term, but specifically answering to your question about how much time you should look at from a long term investing, we generally recommend people coming into an equity category of investment, your time horizon should be at least 5 to 7 years. If you see the past history since inception till today, if someone would have invested in an index, the probability of losing out the money in a 7-year period is hardly point some percentage. So there is very less amount of probability of losing money if you have invested over a period of 7 years. An average return, a person who have invested in 5 to 7 years, when you talk about rolling returns, the index has given 14 to 15% annualized return. So generally we tend investor to say, okay, you should look at from a 5 to 7 year if you are coming in an equity fund per se. But if you have a lesser horizon, you can look at other products which are available, with the case of hybrid products, which is a mixture of debt and equity.
And we'll talk in more detail about that, but what you're essentially saying is that you, by investing for many years, you benefit from the compounding of those returns that also happen. But you know, Paresh, you know, can one avoid risk, you know, let's say risk of inflation or risk of your money not being lost at all by not investing at all and just keeping your money safe in a bank account? You know, especially, you know, in a scenario like this where, you know, people are circumspect about, you know, where the economy is headed. There are lots of, you know, bad headlines coming in on geopolitics. You know, the markets themselves don't look, you know, too promising. So, you know, is that a good option to not take the risk at all and just sit back for some time?
See, not taking a risk is not a question only, because you are taking risk every day in your daily life. While coming here, I took a risk by coming by car or walking on crossing the road. So risk is always there. Now you have to understand the risk, right? When you walk on the road or when you are running on the road for a marathon practice, a tree can fall on your head. That risk is always there. But there is the survival problem. But in investing world, if you have done your due diligence well, and if you have invested according to the time horizon of the goal you are trying to achieve, there is absolutely no risk.
So
there is only volatility on the way. So for example, not taking risk at all, you are investing in an FD of a nationalized bank. So it is 100% safe capital as long as good government is there. That will rise every day. Right? Okay. The stocks or the mutual funds or the debt funds, or they will not rise every day. Their journey will be volatile.
In spurts.
But the returns will be always more. Because of the fundamental rule or fundamental basis where stocks are generally compounding at a much
and I think
faster
any
rate.
historical chart will show you, you know, how mutual funds have outperformed, you know, bank FDs or many other asset classes. But Saris, you know, I want to ask you a specific question.
So I'll just add one more thing in that. See, bank FD, instead of doing bank FD for 10, 15, 20 years, even if you invest your money into that bank's shares, you would have done phenomenally well. Because what is the bank doing? Bank is taking your FD as their raw material, making a finished product of called loan, and giving it to lenders. So you are allowing the bank to make money on other people's money. Right? So might as well invest in the bank
benefit
itself.
From the rise in their stock price. Okay, but you know, I want to ask you a specific question about you know, mutual funds, and you know, whether all mutual funds are equally risky, or you know, how does the risk associated with a type of mutual fund change? Let's say with equity, hybrid, and debt.
So broadly, mutual funds you can divide into two broad categories, which is one on the equity side, the other on the debt category. On the equity side, equity funds invest into underlying stocks, the equity markets, and on the debt side, the funds invest into credit papers, corporate papers, commercial papers, government securities, and various other instruments. So the risk in the debt fund could be of the interest rate risk, which is the interest rate volatility, or the credit event if it all happens. The risk in the equity would be the volatility risk, I would say. In a shorter term, what actually investor feel which is the biggest risk in an equity is the volatility risk or the chances of losing money, but that is the short term risk what they are carrying in an equity fund. But actual what is the risk, which is the inflation risk,
Right.
which an equity fund can only be able to beat that inflation.
Absolutely.
So broadly these two categories are there. There is a category between that, what you mentioned
Hybrid,
is the hybrid category. It's a mixture of equity and debt within different percentage, going from 20-30% of equity to 70-80% of the equity. So from a moderate or probably a conservative investor should look at a debt fund, a moderate risk investor should look at a hybrid fund, an aggressive investor can look at as an equity fund.
Equity fund. Okay, we just take some questions that are coming in from Facebook, and this is Mr. K. Mahapatra who's asking, should my investments increase with my income?
That's a right thinking what he is going through. In fact, as he said, the SIP, generally what we ask our client is to do a step up SIP. SIP is systematic investment plan.
Yeah.
So we ask our client in fact to do a step up SIP so that the saving components day on day gets increases, and which would help to create a larger corpus over a long period of time.
Okay, Paresh, we have Mr. S. Kumar asking, I want to buy a house in 5 years. What type of fund should I invest in for this goal? So, given the current situation, what would you advise?
For 5 years, you can easily look at doing an SIP into equity to reach your goal of buying a house in 5 years. Because what I personally think is house prices are not going to increase for another 5 years at least.
Right.
And equity will definitely do well over next 5 year period. It has always done well. And since he will be starting when the markets are really low, what they can further go low by 5-10% or 15%, but the downside is limited and upside is unlimited.
Right. But given that perhaps he can do a bit of bottom fishing in real estate right now, wouldn't it be better for him to put that money in EMI rather than in the markets?
No, real estate cycles are really long.
Okay.
So we had a cycle from 94 to 2004 which was downward, then from 2004 to 2013 which was upwards. So my personal judgment is that we will start reviving the real estate only in 2023.
Okay.
So if a person wants to really invest, he can wait for investing. And the thing is so bad that if you want to buy an under construction house, there is no guarantee that it will be delivered.
Right.
So rather wait till you find the right house and buy it after 5 years.
Okay.
Till that time you will be able to make enough money to buy that house outright.
Right.
If you plan it well.
Okay.
So for that you have to go to a financial planner, exactly work out how much SIP you should do to reach that goal.
Right. I just want to extend his question, broadly for our viewers. What's your suggestion for the type of mutual funds that investors should be looking at? I know, all of this is goal based and so on and so forth, but let's take an example of a first time investor who wants to put in some bit of his salary into an SIP, and has a 5-7 year sort of horizon.
Right.
What sort of funds should he be looking at right now?
So SIP actually can be done into all kinds of products, whether it's your equity, whether it's your debt. So first time investor, if he has a long term horizon what he would have, then he should look majority of his savings into an equity SIP. That is what I would suggest. Do some portion of SIP into a debt fund also, which would help for his immediate requirement if at all he requires so. So a mix of both equity and debt, what he should look towards it. Majority should go towards the equity SIP.
Right. What's the importance in all of this, of a financial planner? Because a lot of first-time investors, wouldn't really have the wherewithal or the knowledge of, knowing where to put their money, how to gauge the performance of a mutual fund. So what does a financial planner do, and how important is it for you to, enter the space with the help of a coach?
Yeah. See, financial planner is basically looking at the holistic picture of that person or that family.
Yeah.
He understands the whole background first. Normally we take 2 hours to understand what is your family, what is your background, what are you looking for, what are your immediate goals, future goals, your family is expanding or not, and accordingly then we come out with a plan. So that plan contains everything. It contains tax planning. That is the first thing, because tax takes away almost 1/3 of your income.
Yeah.
So wherever tax can be avoided legally, that should be looked at.
Correct.
After that, you have to make a household budget. After that, whatever is left, you have to start investing. Then you have to draw the goals, and then you plan. So we start at the age of 25 also. If somebody comes to us, we do his risk. Then most important thing is risk management. His life insurance, his medical insurance, his professional indemnity insurance if required, if he's a professional. All that first is risk management, then tax planning, then investment, then even retirement planning can be started as early as he starts earning.
Right.
Because then the amount required will be very small.
Right. So the financial planner takes a holistic view. But for
even, in fact, just want to add,
Yeah.
even the world's most powerful leader, Mr. Narendra Modi,
yeah.
who requires a coach or a guide for his expertise adventure trip to Jim Corbett
Yes,
in the
yes,
form of
absolutely.
Bear So
Yeah.
definitely an investor requires a financial advisor for his long-term wealth creation, as Parishji what mentioned, what all things he would take care to make sure your financial goals have been achieved.
Right, but one is of course taking help of a financial planner to help you invest a certain corpus. But what's a step-by-step method of actually creating a financial plan for yourself in terms of the thumb rules that you need to follow, how much you should save, how much you should spend, how much of it, let's say, needs to go into emergency funds or insurance. Just give me a sense of how the whole sort of puzzle should fall into.
Yeah, so first you need to identify your goals.
Yeah.
Once you have identified your goals, you need to prioritize it within that goals. And then once you have prioritized that thing, you would be able to understand how much I need to save for that goals, and how much I can spend for my living. Once you have done with all that thing, how your tax planning, your investment vehicles and other thing would follow within that financial plan, which would make sure you achieve your final intended goals which you have.
But are there any basic thumb rules that you can't spend more than 30% of your salary or 50% of your salary, or something like
There
that?
is nothing like that, because what happens is when somebody comes to us, first we have to identify his goals,
Yeah.
make planning for his goals, because these goals are very important. After that, we'll tell him that only this much amount you are allowed to spend. So let's say his earning post-tax is X. Investments required to meet all his goals is Y. Then we'll tell him you are allowed to spend only X minus Y.
Yeah.
You don't decide your spending first and savings what is left.
You first save.
You
and
have to
then
first
spend.
save
Yeah.
towards your goals, or you have to reduce your goals.
Okay.
There is no other option.
Okay.
There is no magic wand here.
So in initial phase, if you ask me, initial phase the spending is slightly higher, the saving is less. But as you grow up the ladder of your career, generally the savings would increase because the spending would not increase at the rate what it would. But the but your salary or
Absolutely.
incomes would increase. So your saving habit should increase over a period of time.
Absolutely.
So that is how I would take it.
Yeah.
In that.
Let's take a couple of email questions that have come in earlier. So, this is Amit Sharma asking, what's a better option for retirement? Investing 2,000 rupees from the age of 25 or 5,000 from the age of 35?
Right. So definitely 2,000 from the age of 25, because one, he has a very long tenure. So the compounding of thing would happen in a much bigger way, because the initial amount which he would have invested would take number of years more. The compounding effect would take care. Assuming the retirement age is the same.
Yeah.
That is what I would say.
Yeah. You have Deepak Chatterjee who asks, my dad is 65 years old and he wants to invest in equity funds. Do you think it's a good idea? So 65, perhaps, he shouldn't be having a very sort of long-term goal, should have a medium to,
Yeah, I know, but see, for every individual it will be different.
Yeah.
For example, if this 65-year-old already has pension, which is enough for him for his expenses and goals, then he can invest 100% into equity also, right? It depends on valuation of equities at that time, and whether he requires that money immediately or no, and whether all his other things are being met through other sources.
Right.
So I have a 90-year-old guy who is 99% in equity.
Oh wow, really?
Yeah, because the remaining 1% is enough for him for his daily expenses and monthly expenses.
Right, right.
So it is not age related at all.
It depends on your risk appetite.
Yeah, not only risk appetite, risk tolerance.
Yeah.
So if, for example, if a 65-year-old guy comes to me and says, where do I invest? If I look at his other portfolio and if I see that next 10 years, even if the market shuts down, if he has enough money to survive for next 10 years,
Right.
he should be investing everything in equity.
Okay.
Because within 10 years, his equity portfolio will more than double or triple or quadruple.
Right. Okay. One more email question. This is from Sunil Kumar Singla. He says, I have 50,000 rupees to invest. Should I invest in equity mutual funds through SIPs or lump sum?
Yeah, so both are very different things. SIP
Yeah.
is a periodic investment, what you are
Yeah.
doing it. So if he has a lump sum investment, I would say invest into a liquid fund, stagger your investment over a period of 1 year, so that you do a rupee cost averaging over a period of next 1 year of the volatility. So my suggestion would be to go with investing in a liquid fund and stagger your investment over a period of 1 year in the equity category.
Okay. So, as we start,
Basically,
yeah.
I'll just add to it. Basically, what is SIP is monthly lump sum.
Yeah.
So there is no difference between lump sum and SIP. Lump sum, SIP is monthly lump sum. So if you have the money right now, invest it right now. SIP is for whom? Who is earning monthly. He doesn't have any money now, right now. Every time his salary comes, he is investing. So what is he doing is he's investing lump sum only, but monthly.
Okay. More questions coming in from Facebook. So this is Charmi who asks, I'm 26 years old. I wish to buy a 1 crore rupee property within 1 or 2 years. How should I plan for it? Also, is it feasible to go rent rather than buying property outright? I think this is a very interesting question because there's been this whole debate about renting versus buying. The liquidity and sort of how that squeezes out when you buy something. Also the fact that you're paying just about 2-3% rent, so that economically it doesn't make sense. So what would your advice be?
So in fact, what you said rightly, okay, today the rental yields on majority of the property are at roughly around 1.5 to 2.5 or 3%. When you have an interest rate which is going at 7.5 or 8%, and the rental yields which are going at 1.5 to 2% kind of a thing, then there is definitely a price correction or a time correction happening in the real estate segment. So one option, if she is comfortable with staying on rent, earlier why people used to buy property, it was an emotional connect also which is there, but the young generation are fine living because they want flexibility. While they are working, they want the flexibility. When the rental yields today at 2.5%, I would rather stay in a rent and invest my surplus money and make that money earn much higher than what I would have earned into the real estate property out of it. So
like he said, younger generation is not very fond of physical assets. I mean, we've seen that, but will she, by not investing in real estate right now, perhaps miss out on the appreciation that real estate gives? Because that can also be exponential if you invest in the right place.
Yeah. See, last 50, 60, 70 years in India, people who have invested in property have seen only the upside.
Yeah.
Why? Because India was always a high inflation country with lot of black money. So the real estate prices were going up. Black money guys had, instead of one house, they had 10, 15 houses where they park their black money. Now that is going, inflation is coming down. Real estate is not likely to give the returns which they gave 50, 60 years back.
Right.
That is one. Second thing is, in last 20 years, mobility of labor has increased in India. People keep changing jobs like every day. Mumbai, Bangalore, Pune, Chennai, Hyderabad. Now if you are stuck with a property, you don't know what to do with it. It is illiquid. Today there is no customer coming to even look at your real estate property. Forget about negotiating.
Right.
So instead of that, if you are moving your job, you don't have to think. If you are putting your son in BKC for studying, you can shift to BKC.
Right.
Or you are working in BKC, you can easily shift to BKC on rent.
Right.
Rather than getting stuck in a Borivali property which you can't sell.
Right. So would it be fair to say, that, perhaps if you're looking at real estate for primary use, then it makes sense, but definitely not for investment.
Definitely. In fact, it's a misnomer also. Okay, people have made a lot of money in real estate. If you actually see a few properties in Bombay, like which were the headlines of the newspaper, like Samudra Mahal property,
Yeah.
or you talk about Rajesh Khanna
Yeah.
property, 1 lakh becoming X amount of thing. But if you actually see the time what it has taken and what is the annualized return on that, if you calculate that thing, the annualized returns are coming between
It's
10 and 12%. kind of-
Suboptimal.
yeah, so when you compare with the same with an equity asset class, the annualized return from index what it was started till today, it has given more than that return, which is right now around 14.5-15%. So because in real estate we talk about values, that value of 1 lakh becoming few crores. In equity we generally talks about percentage, but when you talk the same language at both the place, this as an asset class has given much higher return than the real estate as an asset class in the past also.
Right. Finally, we have to wrap up. Just one question before we do that. In this sort of turmoil, one of the biggest mistakes that people end up making is that they often, book losses because, fear takes over rationality, it somehow messes with your human psychology. So, how does one tackle a downturn and come out unscathed? Since the topic of our discussion today is about running the race and not being fearful.
Yeah, so people living the marathon halfway or within 1 hour of running, they are basically, in my terms, booking losses, which were theoretical losses before. Now you have made them practical by living out of the race. Similarly, in equity investing, if your investment has gone down and if you sell it, it's an actual loss. Till that time, I call it a quotational loss. Because why it has come down? Not because promoters are selling or owners are selling. People who need money may be selling. People who are scared of the stock market and the companies may be selling. Promoter never sells. So in a particular day in a stock market, the market is falling because on that day there are more sellers than buyers. Nothing has changed in the company.
Right.
In fact, I have a classic example which I share with my clients is of a Chinese bamboo. Chinese bamboo across the world, it is the largest grass which grows to 80 feet height. It takes 5.5 years to grow to that height, but on the initial 5 years, actually it just grows by 2-3 inches above the ground. In last 3 to 6 months, it actually goes from 2-3 inches to 80 feet. So this is the same way you need to nurture your investment, you need to fertilize by building your corpus over a period of time, and on a longer period you would create your wealth. So
Alright.
that is what I would sum up saying, in a turmoil market you should continue your strategy, continue your investment. In the long term, you would definitely create long-term wealth.
That's an excellent analogy to end on. And the message is pretty loud and clear. Don't let the fear of losing keep you from running, and certainly don't get afraid of all of those headlines and so on. If you are a long-term investor, you will end up making money at some point. Thanks very much for joining in. Thank you to our guests for joining in as well. Do join us again on the 29th of August, 5 p.m. onwards. A very interesting topic, especially for those who just getting into their first jobs. We're going to be discussing smart money moves to make at your first job. Thanks for watching.